Okay. Hello, everyone. Welcome, welcome, welcome. Welcome all my regulars. Welcome to the newbies. If you're new, big welcome. I'll let you know what we do here. My name is Jerry Hogenhout. This is just a very simply a seminar that I do every month. We pick a topic, we talk about it. It's also your opportunity to ask questions if you want. It's just a free service that we provide for anybody that's interested. Our goal is simply to provide good, unbiased financial information, either on a tax for taxes, investments, financial planning. Uh, Again, my name is Jerry Hogenhout. I'm a chartered professional accountant. I'm a certified financial planner. My company is Canadian Investment Services. And again, this is just a service to anybody. So I just got to watch the people coming in. So anyway, so tonight we are going to talk about that goddamn budget that just came out. We're going to talk about that. We're going to do a bit of a deep dive into the capital gains increase. What does that mean? A lot of us here, certainly our company, we focus on real estate investments. Lots of real estate investors here. So we're going to talk about really what that impacts, how that impacts real estate investments. We're going to do a brief description of some other things that might be of interest on that budget. And then we're going to talk about our every now and again, I pat myself on the back, I got to admit. So we're going to talk to you about this new pension plan that we're doing. We're going to tell you to stop paying Canada Pension. And I'm going to explain to you how you can create your own pension. And we've designed this. I'll explain it using silver bullion. Again, not often, every now and again, I pat myself on the back. This one is one of my better creations. We're also going to talk about our financial planning club, what that is, what that means, what you can expect. All right, so let's talk about this federal budget. Hold on here. Let me just keep getting people in. Okay, so before I'm going to talk about the capital gains, I'm going to talk about a couple of other things in that budget that may or may, in all probability, aren't applicable, but I'll just highlight them just so at least you know that they're aware. Lifetime capital gains exemption has nothing to do with this increase of this capital gains exemption to 66%, but there is what we call a lifetime capital gains exemption. It was always $1 million. It has been increased to 1.25. Okay, so we're kind of happy about that. It's still way less than somebody is making noise here. Okay. So that has been increased. Salish, I think we're hearing you here. So
Sorry about that.
that's okay, no worries. Where that $1 million exemption, which is now up to 1.25 million, where that applies is really the sale of farm property, okay, or the inheritance when farm property goes from through an estate. We have now up to 1.25 million to claim as an exemption. It also qualifies as for the sale of what we call small business qualified shares. So if you have a company, if it's a qualified company, you get to claim a 1.25 exemption on those shares, which sounds great. And it is good, don't get me wrong, but a lot of times when we deal with the buying and selling of companies, we're not selling the shares, the purchaser is buying the assets of the company. So it sounds nice, it is nice, but it's not really as effective as it should be. Sure wish they included cottages on that $1.25 million exemption, because we'll get into that, but it doesn't. So anyway, so the lifetime capital gains exemption has gone up to 1.25. If you own a company, you have shares, that might affect you. If you have farm property, that will help you. There's this, oh my God, accelerated capital cost allowance. Isn't that brilliant? We can now immediately write off the cost of our computers. Brilliant. It's just brilliant. We've been doing that for quite a while, so I don't know if we've been doing something wrong, but the government now is letting us claim 100% of the cost of our computers. Brilliant. There is what's called New Canadian Entrepreneurs Incentive. Lower capital gains inclusion to 30 to a third. So that's just again, if you're an entrepreneur, if there's a sale of shares to an entrepreneur, that tax rate is reduced. There's something they've been working on for a while. They addressed it again in this last budget. Employee ownership trust, kind of interesting in concept. Basically, it's a capital gains exemption if you sell the shares of your company to your employees, and you have an exemption up to $10 million. Great. Don't see it often. Haven't really, over 40 years of tax, I've experienced that maybe 5 times where the owner is selling to their employees. So nice little gesture. Not sure how many people it's going to affect. The home buyer plan, that went up from 35,000. That's the money you can take out of your RSP for a first-time home and then repay it back over 15 years. So 2 things they did. They increased it to $60,000. You can now pull out $60,000 out of your RSP for a first-time home buyer. And it's always been 15-year repayment period, but now they've given you a 3-year deferrals, which means you don't have to start paying. So if you pull the money out of your RSP to buy a first-time home, you can pull up to $60,000. You don't have to make a repayment for the first 3 years, and then you have 15 years to repay that back into your RSP. I'll give them a check mark on that, but it's almost them admitting that, hey, sorry, first-time home buyers, it's almost impossible for you to buy a first-time home, so we'll give you a little carrot, whether you use it or not. But it's something, so we'll take it. Accelerated capital cost allowance for purpose-built rental properties. Big deal, okay? I don't let any of my clients claim capital cost allowance on their rental properties because you're just going to pay tax when you sell it. We call it recapture of depreciation. Why would you claim depreciation now when you're going to basically pay it back when you sell your property, in all probability, in most cases where I see it, in a higher tax bracket? So not much there. Anyway, those are just little things that are in this budget. Okay, let's talk about this capital gains tax. I've never seen people more angry at a government than they are now. And it's not just me. I belong to this network of like 350 accountants. So that's our little, our network to talk about stuff, ask questions. Oh my God, we as accountants are just so angry. Our clients are so angry. This is nuts what's going on in our country as far as the tax they're imposing on us. And anyway, yet another stab in the back. Now our capital gains tax goes from 50% to 66.67. Lots of misleading information. Blame the media on a lot of this stuff. People are coming to me and going, I have to pay 67% of tax on my gain. No. Okay, you basically have to include 2/3 of the capital gain into income. So if you bought a property for 300,000, you sold it for 200,000, you made $100,000 capital gain. You don't have to put the $100,000 capital gain on your tax return. You have to go $100,000 times 66.67%, which will be $67,000. That's the number that you put on your tax return. And then it simply depends where that number ends up on your personal tax return. It'll depend on your marginal tax rate. If it's on a corporate tax return, it'll depend on that tax rate. The one little carrot they did give us is that on personally, the first 250,000 of the capital gain is still taxed at is only the inclusion rate is still only 50%. And I'll explain that in a little more detail. But anytime we talk about capital gains, we should do a little history lesson. Okay. Where did it start? What is it all about? Let's go way back. Okay. Let's do this real quick. Income tax. Let's even talk about that. It started in 1917. Okay, financing World War I, and it was temporary, and they fooled us then, and they're fooling us again. Okay, it's not temporary. But anyway, so at first, back in 1917, when they introduced income tax, there was no capital gains. There was no such thing as a capital gain. You got to sell your property and pay no capital gains tax on it. Okay. And really it was intended to people to invest their capital simply other than putting it in the bank. So fast forward to 1972, complete overhaul of our tax system. And that was where capital gains was first introduced. Okay. And it really, back then, I do remember it was basically to get brought in to in lieu of inheritance tax. So we did have inheritance tax, and that was eliminated in incomes capital gains. To think that maybe we don't have inheritance tax anymore. Well, we don't, but we sure pay a heck of a lot of money on our final tax return. And we'll talk a little bit about that too. So once again, maybe a little trickery. So but in 72, they bring in capital gains. Okay, so the nice thing back then was people had two principal residence exemptions. Okay, and very typical back then was you would have a principal residence exemption for your house, your principal residence, like we do now. And you would also have a principal residence for a second property. And in most cases, that would be a cottage. And that worked out really, really well. And that was, we had the two principal residence exemptions for 10 years. So from 71, basically 72 to 82, we could use these double exemptions. Put this guy in. So that was a good thing. 82, they took away that second exemption and have never brought it back for us. So that was up to 82. So from 1972, when they introduced capital gains tax, all the way to 1988 is when they all that time, any capital gains would you had to include 50%. Okay, of whatever if you made $100,000, only 50% of that landed on your tax return. And a couple of interesting things happened along that way. 1980, you might remember what the interest rates were. Well, some of us will, some of you won't. But they were at 20%. Okay, interest rates were 20%. And back then, you just kept your money in the bank, and there was no need to invest in anything. You were making 20% of the bank. Mortgage rates were pretty high back then too. But certainly 20% interest rate was the norm back then. And so to incentivize people to get their money out of the bank and into the stock market, because basically, the system needs people to invest in the stock market. So to incentivize people to get their money out of the bank and into the stock markets, they created a capital gain exemption, $500,000. Okay, your first $500,000 of capital gain was exempt, and that started in 1985. That was big. Okay, that was really big. So yeah, lots of money left the bank. It went into assets, purchasing of assets. It was supposed to go to push your money from the bank account into the stock market. But back then, they also included real estate to be applicable to that $500,000 capital gains exemption. So instead of money going into the stock market, it went into real estate. And boy, was there an explosion of real estate at that time. Can you just imagine right now if they introduced a $500,000 exemption for anybody investing in real estate? Well, that's what happened back then. Lots of money went into the real estate. So 1988, they realized they made a mistake. So they lowered the capital gains exemption from 500 down to 100. And at the same time, they took the 50% inclusion rate and bumped it up to 67%, just like we are now with this new budget. So they dropped the exemption and they increased the amount that had to be included in income. Okay, so that was all right. Then in 1988, 88, they dropped the thing to 100. And then what happened in 1990, they got really greedy. They realized how much money they were making by bumping this inclusion rate to 67%. They bumped it up to 3/4, 75%. Okay, so we have had a history of this capital gain inclusion rate going up. So back in 1990, from 1990 to 1999, we were including 75% of our capital gains as income. Okay, then 2000 hit and they dropped it down to 50%. Okay, so it was 50% from 2000 and it still is to this day 50% up until June 25th, 2024. So the new budget that was tabled, all this comes into effect in on June 25th, 2024. If it passes, it's just tabled. So let's hope it doesn't pass, but it will. So that's what's coming at us. What do we do about it? Okay, now you got to understand that and it's also not too hard to tell what's going to happen if things continue. I mean, again, it went from 50 to 2/3 to 75% in the past. Don't be surprised if that's going to happen, not going to happen again. So we want to look at what the impact is on this increase of capital gains. What does it mean to us? Now, think about, we as accountants, we look at things as taxable entities. Okay, a person is a taxable entity, a corporation is a taxable entity, a trust is a taxable entity. There's your three taxable entities that we deal with. So again, it affects everybody: personal tax returns, corporate tax returns, and trust tax returns. But as I mentioned, personally, your first $250,000 of capital gains will still only have 50% inclusion. Okay, so let me repeat that. Your first $250,000 capital gain on a personal tax return will still only have 50% inclusion. So it's anything over a $250,000 capital gain that we have to worry about this 2/3 capital gain. Okay, so on the corporation, there is no capital gain. Number one is right up to 2/3. On trusts, same thing. Capital gains right from number one is up to 2/3. So we really, personally, we look over there personally and go, oh, we have a $250,000 inclusion. So, and then everything is 2/3. So what does that mean? So, I was watching a program the other day about with realtors up in cottage country, and they think there's going to be this influx of everybody selling their cottage to avoid the tax. If you close your property before June 25th, 2024, yes, you're only going to have 50% inclusion. If you sell afterward, then you got to deal with the 2/3 inclusion. So does that mean everybody's going to run out and sell their properties with a quick closing before June 25th? I doubt it, but who knows? We will see. If you're in the middle of a deal, if you're negotiating, you got some power on the negotiating. You're trying to buy it. You're in the middle of trying to buy something. You're looking for something, and you have buyers out there. Of course, there's places listed. Now, if you can sweeten the deal with them to close before June 25th, the leverage is certainly in your favor. Okay. So that's probably the only thing I see that far as any leveraging going on. Another thing is on these vendor takebacks, because when we sell a property or buy a property, if we take back a mortgage, okay, we are allowed to defer our capital gain for up to five years. Why would we want to defer it if the tax rate is going up? Well, we wouldn't. But if we're stuck closing after June 25th, we can defer that gain into the next year. Now, the one thing that I've been trying to find an answer on, and I haven't been able to come up with an answer, is if we do defer, if we got a big capital gain and we push, we claim 250 this year and the 50% inclusion, and we defer 250 into next year, do we get the 50% inclusion? And if we defer that into the third year, and we can do this with vendor take-backs, a very common way to buy a property, do we get this 50% inclusion every year for the first $250,000? I think so. It's the way it's written. I haven't got any confirmation from anybody in the government. But anyway, oh, we got a question. Yay, way to go. Hold on, let me see what the question is. I love it when you keep saying only 50. Well, it's not 50% tax. It's 50% inclusion. Then you pay 50% tax. passive income. So what is the increase in capital gain that does not deter the well, I mean, listen, you know, so the question is, will with this increase in capital gains, does that not deter the prospect of buying a cottage? You know, listen, cottage, you know, I'm really disappointed that they haven't allowed this capital gains, the second capital gains exemption in the tax world. How many times have I seen, you know, I've done a lot of final estate tax returns, and the cottage always is a real spot where it's a deemed sale. It goes to the kids. You know, Muskoka worth $2 million. They paid 200,000. So now you get a $1.8 million capital gain. 50% inclusion, that's 900,000. 2/3 inclusion, that's what, 1 point some million. The kids don't have the money. So there goes the cottage. Okay, they have to sell it. Okay, that happens so much. And it's sad because, listen, cottage is memories. We have a cottage. I mean, so many family memories at the cottage. That's what life's about. So when the tax system forces, you know, you can't even pass that cottage on to the kids, that's a problem. And we see it all the time. And that problem is even bigger now, okay, because now there's more of a tax increase. When you're looking to buy a cottage, you know, I don't think a tax decision, when you're looking to buy or sell a cottage, I really don't think it's fair that it, you know, the tax implications drive that decision. I mean, you're going to buy a family cottage if you want a family cottage. You're going to sell the family cottage when you're ready to sell. If you have a cottage and you're thinking, or you've been thinking of selling, sure, yeah, let's get it up for sale and let's take advantage of this tax rate before June 2025. But who knows what will happen? You know, who knows what the impact is on the cottage market? You know, once again, it's not going to be good because there's just more tax to pay. So hopefully some sanity comes in, because it's really sad when we see people having to sell their cottages just because there's a passing in the family and the kids don't have enough money. So that's probably the one thing that has caused more grief and concern, because another thing that happens when a cottage is transferred to the kids through an estate, um, some kids might have the money or the financial means to carry on with the cottage and others don't. So there's a kerfuffle. Okay. People want their money. So anyway, so that's that. Do we look at transferring? Okay, again, three taxable entities, people, corporations, trust. Do we transfer things back and forth to try to take advantage of this $250,000 50% inclusion over 2/3? There is some tax planning there. If you think it affects you, I don't want to go into a deep dive on that. But if you do think it affects you, we can have a chat. I'm not convinced that we got to restructure everything, incur all kinds of legal fees to transfer property from corp to personal, just to avoid this extra income inclusion. So, but we can have a discussion on that as on a one-on-one. So I should encourage, if you have questions, throw them into the chat bar. This is, you know, I'm happy to talk for an hour, but I'm also happy to answer questions too. So okay, so here's the biggest problem that nobody has talked about yet. Okay, nobody. I haven't heard it yet. Okay, and it's the biggest problem that I saw as soon as I heard this news of the budget. The problem is estate planning. Okay, that's the problem. And here's why. Because when we have assets, we either sell them, okay, just we sell them, and then at least if we sell them, we have the money to pay the tax. There's also things that are called deemed dispositions. Okay, we're not selling the property, but as per the Tax Act, they are deeming us to sell the property. There's the problem. Okay, now we have more income to include. We have more tax to pay on these deemed dispositions when we haven't got any money for the property yet. And the biggest deemed disposition is when we deal with estates. Okay, so here we are in our life trying to build up all these assets, houses, corporations, whatever assets we're trying to build, and we all want to use these assets in our lifetime. And of course, we want all those assets to go to our beneficiaries through our estate. For those assets, they just have larger tax liabilities attached to them now. Big problem. Okay, because when we do a lot of estate planning, and what we do in our business, we look at people's assets today. We do some financial planning. We have this little financial planner. We show your assets today, make a whole bunch of assumptions based on the growth of these assets. We add the income that you earn and need with the money that you take out. So we do a whole financial planning session. And I've created this tax page to that financial planner, because one thing I think is very important, and I've yet to have anybody answer this question, which is, how much tax are you going to pay when you die? Everybody's like, what are you talking about? How much tax are you going to pay when you die? I have no idea. So people don't know this, okay? They should know this. This little financial planner we have created shows you, based on assumptions today, we can guesstimate or have a good idea of what the tax implications are. We can program this to age 85, age 90, age 95, age 100. And that gives us some idea with the tax liability that we're dealing with. Now we got to deal with the capital gains inclusion rate that is much higher, which means when we calculate all this stuff, our tax liability at the end of our lives is higher than it was before. This is a huge problem, okay? And when we do all this with the clients and look at their tax liability, what it might be at age 85, 90, 95, there's one of two things you can do. One is nothing, okay? And let CRA take way more of your assets than you want them to take. You don't want to work all your life so CRA can get your assets. You want to give those assets to your kids. Okay, well, right now with this new rule, they're taking more of your assets when your day comes. So that's a problem. So again, when we look at the tax liability, the potential tax liability of anybody's estate, again, one of two things we can do. One is nothing. And the other is we insure that tax liability. Okay, and that's becoming a little more topic of discussion. I'm not the biggest insurance person. I always thought, before I get into this whole tax, investment, financial planning, I always thought insurance was, if you're a young parent, you've got young kids, yeah, you should probably have an insurance policy in case something happens. Once those two kids are on their own 2 feet, I've always kind of thought, okay, do we really need this term insurance policy? And usually it's quite cheap at that time because you're a younger person. So it's not that uncommon as a younger person in the past that you'd have your term policy until the kids are on their own 2 feet. And then if you're successful at all, you build up your own assets and you're going, okay, when I'm gone, my kids are going to be well looked after anyway. I don't need an insurance policy. Then you start to bring in the whole estate planning issue and go, okay, well, I'm doing really well. I got all kinds of assets. Look at me. I'm going to have all kinds of stuff for my kids. And you figure out what's going to happen when these assets transfer through your estate. And there's a problem. You got a huge tax bill waiting for you. Okay, so then you will go back to the insurance concept and you go, geez, do I buy insurance to cover this tax bill? And certainly anything that we can use to hide or shelter capital gains is worth a conversation. So inside of a corporation, I don't want to do a deep dive into this, but many years ago, that same Liberal government told us that if we make over $50,000 in our corporations of passive income, you're going to start to lose the small 12% business rate. Well, that was not good news. 50,000 sounds like a lot. To some people it is, to some people it's not. If you have $1 million in your holding company, which is not uncommon, and you make 5%, you've made $50,000 in your holding company of passive income. Now you're starting to lose that 12% small business deduction. I don't want to go into a deep dive on that, but the moral of that little story is we have to look at ways of hiding, sheltering that income in a corporation. We don't want our corporations to earn 50,000 of passive income. So what can we do? Well, we can take that money inside of a corporation and either create our own IPP, investment pension plan, or individual pension plan, or we put it into these insurance things that we're talking about. A corporately owned life insurance policy can be owned by the corporation. Money can go inside of that policy and be untaxed. Okay, so that's not a bad thing. I'm not saying everybody should go out and do this. But that really is what I've kind of described there is a product of this whole be your own banker infinite banking concept, which in theory is just taking an insurance policy inside of a corporation, using it for your estate. Okay, we're back to the estate thing, because in these policies, there's two things that happen. One is an insurance component, the other is a savings component. The insurance component can cover your tax liability. And the savings component, the whole concept of be your own banker is that you borrow against that the savings component and the policy amount, and then you can create some free cash. So in certain circumstances, these things work, not for everybody, but if that's something that you think that works, we can have a chat. But the point I'm making is, like we always have, we need to look at what we're doing. We need to know where we're going, and we really need to be a little more attentive to what happens at the end of our life. Because I have done over 500 final death tax returns. Probably half of those we have sent half of the money to CRA. That's just criminal. And a lot of the times it's simply because there wasn't proper planning involved. Okay, you really, I can appreciate there's a lot of estate planners out there that, do financial planning, but you really got to prepare these final returns and be involved with the estate lawyers to really understand all the tax implications that happen when assets go through an estate, and what we can do to safeguard against that. So question, thank you. Do capital gains tax apply to the sale of gold or silver? Well, if you tell me about it, yes. If you don't tell me about it, then no. How's that? I only do your tax return based on what you tell me. So I'll leave that, I'll leave the rest of that answer to yourself. But hold on here. Somebody's trying to get in. Oh, here we go. Could you discuss changes to alternative minimum tax? Oh my God. Yep. Okay, hold on. I'm going to touch on that. I'm not going to go into a deep dive because I'm going to lose everybody. The question is, could you discuss the changes to the alternative minimum tax as to how they potential the increased capital gain? Okay, so here's what people need to know. Every time your tax return is prepared, it is prepared in one of two ways. One, the normal way that we all know and understand. There's another way that your tax return gets calculated that most people aren't aware of, and it's called the alternative minimum tax way. And in very simple terms, without getting into the complexities of it all, if you use too much tax sheltering to bring your income down to a, as per CRA, unreasonable amount, it will trigger what we call alternative minimum tax, which is a prepayment of tax. So when this alternative minimum tax is, again, every time we prepare a tax return, it's calculated two ways. 98% of the time, probably 99% of the time, we never have to deal with alternative minimum tax. But when we do, and if that applies, we're paying tax that we don't owe. We still have to pay it to them, and it goes into our tax installment account. And we draw that down over the years. That's as much as I'll say about alternative minimum tax right now. So yes, so this negatively affects your alternative minimum tax calculations itself. Glenn, I don't want to go into a deeper dive, but we will have a chat on that if you want to. Okay. Where was I? I forget. Oh yeah. So anyway, so so I see a big problem in what's coming at us as far as this estate, what the increase in capital gains impacts our estate planning. And that's something that we really focus on with a lot of clients. So that's a big problem. And all the more reason to at least have discussions. I encourage everybody, again, this whole insurance thing, it's not for everybody. I'm not the biggest advocate of it, but I also don't like sending 50% of the money to CRA. It's something you should try to gain an understanding on. I'm happy to help people understand it better. and then make a decision. But if you have a corporation, in simple terms, it certainly works well for people who have corporations and are making decent income and above. Okay, so if that's you, then you should have a discussion. It also works if you don't really make, if you still make a decent income, but you don't have a lot of disposable income, it can still work. Just doesn't work as well. Any questions on this capital gain thing? Because I'm rambling on here a bit and I want to touch on a couple of other topics. So it's nothing we haven't seen before. I think it's a little more fear mongering than it is. There's a big there's an increase. It's not a huge increase. But we have a question. Fernando, let me unmute you. Open it up. Fernando, how are you doing? I can't hear you. Oh, are you there, Fernando? You got your hand up. Don't be shy. Okay. I can't hear him anyway.
You're now or no? There we go. Sorry.
Hey, how we doing?
It's one of those weird good things. It's one of those weird things where Zoom seems to hate when you change audio sources. So uh, uh, I was wondering, and maybe it's not clear. Oh, forget to switch back my car. But maybe it's not clear yet. What about like kind of nesting? So let's say that you have a holding company, and then an opco that holds each asset inside of it, right? Which is a very complicated, very expensive legal way of doing it. Technically, when you move one of those assets within that opco, each opco would be able to qualify for that 250,000. I guess that's what I'm trying to understand. Is there a way to kind of like shelter inside?
No. Okay. So Fernando, the 250, it's not even an exemption. For a person, the 250,000 of capital gain only has 50% inclusion. Everything above that is 2/3. Corporations don't have that 250. So if you're saying you got a property in a corp and you're trying to transfer to another corp, you're not getting that 250. The only little bit of opportunity might be if you have a property personally that we might want to transfer into a corporation, but you're incurring deemed disposition. You have to do this at fair market value. There's tax implications. Your lawyer is going to charge you through the roof. And by the time that dust settles, have we really made any tax gain? Some cases, yes. Probably some cases, no. So,
okay. All right. Yeah, you're right. As I was saying the question, I was like, oh, wait, yeah, the corporation doesn't get that.
Yeah, it doesn't get it there.
That exception.
So certainly I've been asked a lot since that budget, should I hold the property personally or should I hold it in a corporation? Like if you're buying a property and you're asking me, should I hold it personally? Should I hold it corporately? And boy, I don't know where people get all this misinformation, but I've heard way too many times that people who own properties personally are being told, oh, you got to transfer them into a corporation. No, that makes no sense. Okay, net rent income in a corporation is passive income, taxed at 50%. We do not want passive income, we do not want net rent income in a corporation. If we do, then we need to create a second company, which is a real estate management company, because then we take the net rent income from company one and we transfer the net rent income over to company two as management income. And there we can pay the 12% tax because management income is active income. But it has to be reasonable. Okay, CRA has rules and regulations about how much we can do with this. So, those that know me know I help clients push the envelope as far as we can within reason, within the law. But there's a lot of tax planning that can be done on that way. I have another hand up. Hung Lo, how are you, my dear? Are you there?
Yes. Can you hear me?
I gotta say, I love your hair. Okay. I'm gonna do the same. I'm gonna get some of that hair color and put it up here. Anyway, what's your question?
So my question was just to see if I'm missing something here. So I did the calculation and like based on like a 100 million, yeah, sorry, on $1 million capital gains, if I held it for more than 7 years to recoup that extra percentage of the inclusion rate, I just need to make sure that I'm in a property that has appreciation of more than 1.5%. So when I look at it that way, as like if I'm going to buy an investment property and I hold on for it for more than 7 years, then during that 7 years, I'm going to recoup that difference in the inclusion rate. So then if I'm buying for the long term, then it really shouldn't make a difference. So am I missing something with that?
I'm missing something because I don't understand what you're saying. Okay, hold on here. So you've got to put your, where's this 7 year hold coming from? Where's that?
So the amount that I would be, the difference in the amount that I would be paying between the 50% and the 66%,
Yeah.
that amount, if I held on to the property for 7 years, I would recoup that amount. And it would only take 7 years at like 1.5%.
If it appreciated, if it went up, if the property didn't go up a penny, and based on the tax rules the way they are today, and you hang on to it for another 7 years, if the tax rules are still in place, you're still paying the same amount of tax in 7 years as you are today. Hey, your mortgage has gone down, so you're certainly winning. But the whole point is 50% is enough. So you're going to hang on to that property for another 7 years, and now you're going to pay 2/3. You're going to include 2/3 of the capital gain into your income times your tax rate, whatever that is. I don't know, not very often do we have taxes driving our decisions. You're going to buy a rental property if you want to own a rental property, if you want to be a real estate investor, and you're going to do whatever you're going to do in your business model to become successful. The tax rate is just an obstacle. So I don't know, unless I'm missing what you're saying. I don't see where hanging on to it for 7 years is going to recoup anything, other than if the house goes up and the mortgage goes down, which it will, hopefully. I don't think I've answered your question. And ask it again.
I think she's saying that after
Backing
7
up.
years, if the difference is like 20,000,
Backing up the truck.
depends on how much it goes up, right?
What do you mean?
Well, of course, if your house is going to go up, let's say the extra tax you're going to pay, and let's assume your house goes up, sure, your gain is going to cover that extra tax you're going to pay, but that's still, that gain should be yours, not theirs. Right?
Right.
So help me here, because I'm missing, I think I'm missing your question.
So I think my question is like the change in capital gains inclusion, it seems like a big increase, but if you hold onto a property for a long period of time, more 7 years or more, then that increase isn't that big of a deal because it only works out to be about 1.52%.
Oh, I see what you're saying. So you're saying, okay, they've hit us, they've increased our tax from 50 to 60. So it's gone up 13 or 20 or 50, 20%. It's gone up 20%. Okay.
I know it's
so
inspection.
Quincy, please.
Specifically which part
Quincy.
ask for the documents, or you just
Quincy.
The only thing he asked me for, the guy that conducted my thing.
How do I mute this guy? Hold on here. Where are we? Okay, I see what you're saying. You're saying the capital gain has gone up however percent from 50 to 60. You're saying if you hang on to it for 7 years, that's a minuscule tax rate. Now I got it. Yes, you're right, but it should be your money, not theirs. So that doesn't soften the blow at all to me. Because once again, in my world, I'm saying, great, you're going to hang on to the property for 7 years, maybe more. We now have a bigger problem in your estate planning because, you're going to do one of two things with those properties in your life. You're going to sell them or you're going to keep them. And if you keep them, they're going to go through your estate. And when we deal with your estate, we're sending CRA a bigger number now. regardless if it's 1% for 7 years, it's still a bigger number that we want to pay. There, we got some action here. You may be correct, but you're still behind where you would have been as of today. Bingo, exactly. So just accepting this increase
Yeah.
and going, okay, that's all right. I'm going to hang on for this 7 years, so it's only 1% a year. No, I don't buy it at all. No, sorry, but I do agree with your logic. Okay. Any other questions? Because I'm chomping at the bit to talk about this amazing invention that I've done. But I will listen. If anybody's got a question on this capital gains thing, jump in now. And if not, I cannot wait to tell you about my new individual pension plan. Okay, so as most of you know, and the newbies here are going to learn a little bit about me here, because I have said for a long time, stop paying Canada Pension. Canada Pension is, in my opinion, just my opinion, one of the biggest ripoffs out there. Okay, and I'll share my story again. Most of you have heard it, but for the newbies, when you calculate what you have put into the Canada Pension Plan, and when you calculate what you get out of that Canada Pension Plan, something is wrong. Something is really wrong. You have put in way more money than they're paying you. Okay, that is wrong. Okay, and I'll share my example of my poor friend who died at age 64. Okay, he was a HVAC guy, which means he worked really hard every day, and he worked very hard from age 18 doing HVAC all the way up to age 64 doing HVAC, contributing maximum into his Canada pension, which means there's probably close to $1 million in his very own Canada pension plan. We all have our very own Canada pension plan. All these premiums that we pay that are deducted from our pay in our life goes into our very own Canada pension plan. This guy, my friend, dies at age 64, did not have a surviving spouse. And as sad as that was, I know his son very well. And when his son got a check from Canada Pension for $2,500, he reached out and said, "What is this?" And I said, "Well, that's your death benefit from the Canada Pension Plan." And he's like, "But my dad contributed to the Canada Pension Plan all his life. Where's the rest of it?" Okay, they stole it from him. Literally, they steal your money. Okay, it is the worst thing in the world. Okay, now, so and again, I just dealt with him. Oh my God! So just 2 weeks ago, I'm dealing with this client, and he's 68, and he sends me his reassessment from CRA, 68, collecting Canada pension. And he goes, "Why am I getting a reassessment that I owe Canada pension? I'm 68, I collect Canada pension." And I'm like, "Oh, you forgot to tell them that you're collecting Canada pension at 65. And he's like, "What do you mean I have to tell them?" Yeah. So now so I'm like, he's like, "Well, why do I have to tell them? They know they have my tax return. They know I'm collecting Canada pension." And I said, "I know, but you still, if you don't tell them, they're going to keep assessing you Canada pension." Another reason to just horrible. Another reason, if you're 60, you can collect Canada pension early at 60. Okay, you take a haircut on it, but you can collect it early. You still have to pay premiums until 65. You cannot tell them to stop taking premiums off your paycheck. So you are literally throwing your money away from age 60 to 65. Anyway, as you can tell, I'm not a big fan of Canada pension. Now, that doesn't mean you should, you got to contribute. So now what we've done over the years and what we've really expanded on is I've always said to clients, look, if you've got a corporation and you take money out as dividends, you do not pay Canada pension. Okay. Now that's good and bad. Good that you don't have to pay the Canada pension. Bad that, hey, you got to, do something for your retirement. We always make sure when the clients are doing that we create a supplementary pension plan. I always say to the client, like right now, if you're self-employed, if you're a proprietorship and you have $50,000 of net income, gross sales minus expenses equals net income. If that 50,000 lands on your personal tax return, you are paying $8,000 in Canada pension before you pay 1 penny of income tax. Okay, let that sink in. That's criminal. Okay, I would rather have that 8,000 in my own pension plan. Okay, the other problem with Canada pension is when you take it out, it goes on your tax return. So you're 65, you collect your CPP, it goes on your tax return. Okay, you collect OAS, it goes on your tax return. You're bumping up your marginal tax rate. Okay, so if you have any kind of a pension plus Canada pension plus OAS gets you out of tax bracket 1 into at least tax bracket 2. Any other income that you're earning on top of that, you're sending 30-40% to the government. Okay, so there's many negative things about Canada pension. So what do? Well, if we are lucky enough to be able to channel our income through a corporation, then we have the ability. The beauty of a corporation is when we take money out of a corporation, we have the ability to characterize the money that we take out. We do not have that ability. We do not have a corporation. So we flow our income through a corporation, and you're going to take some money out. Okay. And we can call it a management fee, a management wage, a management bonus, a dividend, a repayment of shareholders' account, a tax-free allowance. There's all kinds of things that we can call this money that we take out of a corporation. And all these ways of getting the money out of the corporation has different tax implications. Okay, most of my clients, we will take dividends out. Okay, so we take a dividend out. You do not pay Canada pension. You can take about $40,000 out of a corporation without paying a penny of personal tax. On top of that, we can take out some tax-free allowances. So in a lot of cases, you can take $60,000, $70,000 out of your corp without paying a penny of tax. Now, if we do take out a dividend, we're not paying any Canada pension plan. We're pretty adamant that if that is the way the client's going to go, well, you better supplement. You better take that same 8,000 that you would pay and put it into an investment plan in your corporation. Okay, so what we've done is created a system where you can, and keep it simple, say it's 6,000, which is 500 a month, or 7,200, which is 600 a month. We've created a system where your corporation, automatic withdrawal of 500, 600, whatever you want. It can be more if you make more money. We put it into an account, and when we hit 5,000 in that account, we buy silver bullion. Okay, and that's really cool. We are a gold and silver dealer. Okay, we have a contract with Silver Gold Bull. We have a contract with Brinks. So bullion, it's going to we either deliver it to your door, or we store it at Brinks. And that is really, really cool. So what we do is we set up in these corporations. You can set it up personally too, but it works really well in a corp. We set up an automatic withdrawal. So we take $500-$600, we put it into our account. With silver, our minimum is 5,000. When that number hits 5,000, we buy bullion. And then we say to you, hey, where do you want your bullion delivered to? Do you want it at home? Do you want it in Brinks? And that is really cool. People are really starting to. The reason we're into this gold and silver now is simply because there's a large demand for it. And if my gold and silver guy, are you around here, Lazarus? Are you around? Yeah, you are. Okay. I'm going to introduce you to Lazarus. He's my gold and silver expert. He's the one I reached out to when I wanted to get a gold silver dealer. And now him and I have put together this plan that we can create your own personal pension plan with these silver bullion. Lazarus, are you there?
I'm here. Can you hear me?
I can hear you. Why don't you introduce yourself and tell everybody what's so good about gold? Or not, well, gold and silver, but gold is too high. We can't do gold because it's too high of a price on these monthly things. So introduce yourself, say hi, and tell everybody what's so good about silver and gold.
All right, I'll certainly do that. Hey, everyone. I think the last time we had this meeting, I did talk a little bit about gold and silver. So I'm just going to continue on that theme. So why silver and gold? Like Jerry said, we've partnered up with Silver Gold Bull, which is the largest supplier of gold and silver in Canada. And we also have a partnership with Brinks for the storage of your precious metals if you want it to be stored there. So that's very good. Secondly, why silver instead of gold for precious metals? Well, silver has more upside potential, number one. Two, there's more utility for silver. So I personally, from my studies that I've done on precious metals, which is a lot, I see silver as having more upside potential than the precious metals gold because of the utility of it. Everything that we use, from the laptops that we have, from our phones, from our TVs, from the EV vehicles, from everything the government is actually forcing us to be doing within the greener energy, it uses a lot of silver. The solar panels, they use a lot of silver. And there's a discrepancy between supply and demand. So just for your information, it takes almost 10 years to prospect for a mine and bring the silver to market. It takes about 10 years to find a mine to do that. So there is a discrepancy between supply and demand, and that's what will drive the prices of silver up higher, and also just the utility of silver. And that's why I personally promote it as, holding silver, actual bullion. You have more potential to actually increase to make more money than gold. Gold is more of a hedge against inflation. It goes in tandem with inflation. But gold is a storage of value, really, and silver, there's more upside potential there. Did I answer that question, Jerry?
Yeah, no,
Why
it's
gold
good.
instead of silver?
Well, listen, the crazier this world gets, and it just keeps getting crazier and crazier, people seem to run to precious metals for security. And that's why I know myself, when I first started Canadian Investment Services, it was really in order to allow people real estate related investment opportunities as opposed to, or in conjunction with, typical stock market investments. The traditional investment marketplace is not very helpful for people who want to invest in real estate. So to combine the typical investments of stock market investing with real estate investment opportunities seemed to make a lot of sense. Gold and silver at the time I started this company was really never on my radar. Other than just had a lot of requests. People are going, hey, I want to buy some gold and silver. Where do I go? And so next thing, I'm trying to the company I've created is trying to have access to everything that a client would want. So gold and silver seemed to be a very natural fit to what I was trying to build. And then I just started realizing this world that we're in is just getting crazier and crazier, and probably not getting better, probably worse than better. And people are going to run to these precious metals. So we've seen quite an increase in the recent, right, Laz? I mean, this stuff's gone up
100%.
pretty good in the last 6 months, 12 months. But more importantly, or let me say as important, I've been able to use these investment products to create a solution to my anger with Canada Pension. So we can now provide clients a solution. Okay, because listen, if you're putting $8,000 a month a year into your Canada pension account, don't you want that money to go to your beneficiaries? Why should you build up 500, 600, 700, 800,000 in your Canada pension plan just to let the government take it when you're gone? It makes no sense. If I'm going to have 5, 6, 7, 800,000 in an investment account, I want my spouse or kids to get it when I'm gone. I don't want the government to take it. And in all probability, the appreciation on these precious metals will do much better than your CPP. Again, figure out how much you put into Canada pension, figure out how much you're collecting. The math doesn't work. Okay. So, and the nice thing too, because we can now do it monthly, okay, when we're in real estate investing, there's not much we can do monthly. If we're pulling $500 a month from a corporate account, there's not much we can do with that in the real estate market, but we can do that now with these precious metal, the silver market. And again, this is bullion. These are silver bars, silver coins. It's cool. When I first got into this, I said, well, I better buy some silver. So there comes Pure Later with my bag of silver. It's like this stuff's heavy. Holy moly, man. So anyway, we're
Eric,
very happy to facilitate that for people. I think it's a winner. You just need to know where you want this stuff delivered to. And again, the nice thing with these monthly things with the corporation, again, we want to base it initially on what you would otherwise pay in Canada pension, set that up, but you can put lump sums in anytime. You've had a good month, you've had a good year, you got money in the bank. You can, here, Jerry, here's $70,000. Go buy me some more silver or gold. Yeah, no problem. Boom, we're done. Okay, so, and we get a really good, as Laz says, we got a contract with the largest distributor in Canada. We've got super discounts on it. Laz, did you explain the spot price? So when people see the spot price, that's not what they're getting. And do you want to explain that to people?
sure, I'll do that, and then after that, I'll explain the other things that you can do actually with silver, just to add on what Jerry said, silver and gold. So when you look at the price of silver or gold, right now in Canadian currency, I'm quoting it, it's 3,184 for gold, and silver is $37.46. That's what it's at. That's the spot price. Now, no one ever pays this price. This is the price, the spot price. It's the price of silver the moment it's taken off the ground. This is before it's minted. Now, when it's minted, meaning that it's heated and then it's minted into a coin and it's transported to wherever storage is at, this price goes up. So no one ever gets this price. It's more of an indication of where gold and silver it's at, and this is more of a futures price as well. So these prices that we see that are quoted on TV or anywhere, they're not the actual prices of silver and gold. This is just an indication of where the price should be if you just actually got it from the ground as it is in raw form. So that's what these prices are. Does that answer your question?
It does. Somebody just sent me a thing here. It's pretty funny. Didn't Brinks lose 20 million at the airport
Yeah, that
recently?
was an insight.
Yes, it did. That's why we're selling it now.
That's why
We got caught, Laz. We got caught.
we got caught.
Yeah, well, anyway.
Yeah, one thing that I wanted to add on, Jerry, I think just for those that didn't attend the previous webinar, is that we actually do offer precious metals, gold and silver, within registered products. So for those of you that have TFSs, RISPs, first home savings accounts, liras, anything of such sort, you can actually buy actual gold and silver, and again, it will be stored at a Brinks, and it's segregated and allocated to you only. And if it's a bar, it will have a serial number on it, and it will be yours. So we do that as well. Just I wanted to explain that just in case others didn't know. We do offer those services as well. So if you already have an RSP at a bank and you want to diversify some of the assets that you have, you can actually buy real gold and silver within it. So you just have to let us know, and we can help you with how to transfer it and buy the actual gold and silver.
Laz, there's a much better way to explain that, which is get your money out of the stock market in your RSP,
100%.
put them into gold and silver. So
100%.
okay, so anybody interested in that kind of thing that we're talking about, reach out. We're glad to have a chat with you, and we'll go from there. Next top. Thanks, Laz. Thanks for joining us, and thank you for your expertise in the precious metals.
Thanks, Jerry. Thanks, everyone.
Next, we are going to talk about, what are we talking about? Our financial planning club. Okay, here's what's going on there. So in my practice, we do taxes and investments. Okay. And some people use us for taxes, some people use us for investments, some people use us for both. When we work with clients, we usually do financial planning for them. Now, some clients want to do are just happy, thanks for your tax, thanks for the taxes, see you later, bye. Some clients are just happy with us managing their investments and really don't want a deeper dive. Now, there's another group of clients that want a much deeper dive into everything, into taxes, into investments, into financial planning. And we really haven't been able to accommodate that in the past, just because we really haven't had focus on that. So, I mean, of course we do financial planning, but a lot of people want more than what we offer. So we really realized that there was a void and we had to do something about it. So what we did about it was try to create, we're creating, we're just working on it. We're almost ready to launch, but it's just like, again, on the tax side, if I want to join a tax group, which I do, the CPAs, we have tax groups where we can talk about taxes. Real estate groups. Well, I belong to Wealth Genius, and there's a lot of other, that's a real estate group. So there's lots of avenues that we can just talk about real estate. Investments, there's a ton of investment groups that you can join and you can talk about investments. Where's the financial planning groups? They're not there. So there's a void because there's people want this stuff. So we're going to create this financial planning group. And all of these groups, be it tax, real estate, investment, you need a focal point. You need something to talk about, something to link everybody together. Tax world, hey, the focal point is our Income Tax Act. Real estate, the focal point is real estate. Investment groups, the focal point is investments. So in the financial planning, our focal point is going to be our financial planner, which we call financial vision. So basically what we're going to do, we're going to create this group for people who are interested in joining. We call it the Inner Circle. If you go to my website, CanadianInvestmentServices.com, you'll see CIS Inner Circle there. It's not totally complete. There's a lot of information there already. Over the next 2-3 weeks, month, we'll complete it all and be ready to launch. And then, as you probably know, I'm a pretty busy guy, so I have to find somebody to help me launch this thing. So we have to go out and find the best person that we can find. And I hope this person is with us. I think she is. Let me see. Tara, are you with us tonight? Tara, are you with us or not? I see your name. Are you there, Tara? Hello. Hello. Okay, she's shy. Okay. Anyway, Tara is the person that is going to head the financial planning division. Are you there, Tara? I see you. Hold on here. Let me text you. See if she's there. But anyway, so are you there, Tara? There you are. Hey, you're there.
Yeah, can you hear me now?
Yes, we're here.
Okay, I was hearing you on my phone, but I think there was like an audio. Anyway, I'm
Okay,
good.
so
Okay.
we're good. So this, everybody, is Tara. She's the one I reached out to basically set up and create our financial planning group, which again, you'll find information on our website. Go to the website, click on CanadianInvestmentServices.com. Go to the CIS Inner Circle page. You'll get some information there. But tonight you get to meet Tara. So Tara, why don't you say hi and tell us about yourself?
Hey everyone, pleased to be here and thrilled to be joining Jerry at CIS. My personal journey brought me to Jerry on a quest for estate guidance, and I really didn't realize how complex the world of finance and estate planning was and how disconnected it was until I really dove into it. And I could really see where there was a need for people to have a simplified and integrated approach to their financial and estate planning. And this is where Jerry and I sort of came together. What we want to do is have a one-stop shop where people can come for advice on their finances, their tax, their estate plans, legacy plans, investment, retirement, without having to go to 5 or 6 different people and pay exorbitant fees and invest a ton of time and energy into it. So, with Jerry and the other team we have in place at CIS, we've got the legal side of things. We've got tax and investments with Jerry. We've got gold and silver. I really think we've got an entity here that is equipped to provide clients with some pretty strong guidance and a plan that sets them on a path for success. So I'm looking forward to meeting everybody and working with people closely to create that plan for them.
Awesome. Thank you very much, Tara. So what our goal is really to create this group. It's not just us teaching people, it's people interacting together, sharing their experiences. We all learn from each other. So we're trying to build this group. I think there's a big void. I think people want this stuff. What we try to do with our software, which is Financial Vision, what our goal is to teach people how to use this software. What we believe in is that people should be involved in their financial planning. See, one of the problems I see with typical financial planning is in most cases, people are getting it one of two ways. If you go get a financial plan from a licensed investment advisor, they're just going to create a plan and put all the products that they sell in there. Okay, that's not how you do financial planning. 99% of the investment advice that people get are from a licensed investment advisor. That, unfortunately, the way the whole investment industry works, a licensed advisor cannot put your best interest first. Their fiduciary responsibility is to the company that licenses them. Very sad comment, but it's true. So if you get an investment, if you get a financial plan from a licensed advisor, all that's going to be in your plan is whatever that advisor sells. And in my opinion, that's not right. We should be able to, the client should be able to have whatever investment product they want. They like real estate, they should have real estate in their financial plan. They like mutual funds, they should have mutual funds in their financial plan. They like gold and silver, they should have gold and silver in their financial plan. So we're strong advocates of that we really want to provide the proper information and education, not only about the investment products that go into your financial plan, but we want to teach you our financial planning program, which is Financial Vision, so you can participate, so you can play around with it yourself, so you can make assumptions. So that's the goal with this whole group, is to introduce you to our financial planning tool, our software, which is Financial Vision, teach you this, collaborate with others, get into a group environment over time. Eventually you can use this software, this package, to do your own planning. So that's the goal of our club. There's other incentives by joining our club, which you'll find on the website. But that's what we're trying to accomplish, is really for those people. Not everybody wants this, and that's fine. But for those that want to do a real deeper dive and really want to be involved in their own financial planning, this is what we're trying to create, because I really don't see that out there anywhere else. So that's what we're trying to create. We got Tara there to help us create it. We're almost there, and we will certainly be using social media to promote that when we're ready. We're very close, so we look forward to helping anybody that may have interest in that area. So that brings me to 8:45, and that brings me to the end. And usually at the end, I always reserve it if anybody's got questions and answers. I did get some emails of people that did want to have ask a few questions. I'll answer a couple of them here, but feel free, if you got a question, either put your hand up or write something in the chat bar. A couple of the emails that I got. One, UHT filing, underused housing tax. Yep. Okay. So I think most of us know about this. Some of you may not. Underused housing tax. That was something that was introduced by the federal government last February with a filing deadline of last April. We got right to April 30th, and then they decided it was too complicated and confusing and decided just to forget about it for April 30th and pushed it over to October 31st as a filing deadline. So we as accountants got ready for October 31st, a lot of work involved. And at the last minute, the government once again said, this thing is still not fixed. There are still many questions without answers. And then they pushed it to April 30th, 2024 as a deadline, which is next Tuesday. Okay, so here we are Who knows if they'll cancel it again next Tuesday? There are still many questions without answers as far as who's supposed to file this and who's not supposed to file this. It's a dog's breakfast and it's horrible. And I'll tell you why. I'll tell you where they're going with this. Okay. And once again, it's criminal. Okay. So it started UHT, underused housing tax. It all started many years ago when, the affordable housing thing became an issue. They're letting so many immigrants in. We don't even have housing for these people. And all of a sudden, the people to blame are the foreigners that own properties and don't rent them out. They just hold them. Okay. And most of these cases are foreigners with big houses, and they're just planting their money in Canada, sitting on these big houses and just selling them years later and making a fortune. Okay. And then I guess because they didn't rent out their big houses, they're the problem that for all this affordable housing. So that was their target. And I remember when they talked about that, I'm like, yeah, go tax these people. They're foreigners in our country. Why are you letting foreign people buy houses in our country and not even live here? It makes no sense. So yeah, go after them. Well, that's what they did under this UHT, and now they've caught us all. So not only do they go after those people, but they go after everybody. And when I say everybody, here is why. Okay, when we file a personal tax return, okay, our world as accountants, we deal with balance sheet and income statement. Okay, balance sheet are your assets and liabilities, income statements are your income and expenses. When we do your personal tax return, we don't deal with the balance sheet of your life. We deal with the income. Okay, income and expenses. They tax you on the income. They're not asking you on your tax return, what do you own? And because they don't ask you on your tax return what you own, they don't know what you own. Okay, there's the problem. They want to know what you own. By filing personal tax returns, they don't know what you own. Okay, there is no link to the CRA database to the land registry system. They don't know what you own. When we file corporate tax returns, we have to file a balance sheet and an income statement. So on that balance sheet for a corporation, we don't have to identify all the properties that are owned, but we do have to show assets, a number. Could be $5 million, which means you might have 10 properties in there. They don't know what the properties are, but they know you have $5 million of assets. So once again, they really don't know what people own. So they use the excuse of going after all these bad foreign people with these big houses, big empty houses, and it's all their problem to encompass everybody. Now they want to know what everybody owns, okay? So who has to file UHT? The simple answer is, if you have a corporation, if your corporation owns a building, you must file a UHT form, okay? That's simple, okay? If you have a corporation, if you own a building in it, you must file a UHT form per building, okay? If your corporation has 5 buildings, you have to file 5 UHT filings, okay? So that's one. If you personally, okay, if you hold a property in trust for anybody, okay, and that's, that covers a wide range. And there's still questions without answers. So if you have a property, and I've heard CRA say, well, you're holding that property for your children when it goes through your estate. They're saying you hold the property in trust for your kids. Again, still many questions without answers, but the simple answer is, personally, corporately, it's very simple. If you own a building in a corporation, you have to file. Personally, if you have a property and the beneficial ownership of that property does not match what is registered in the land registry system, you got to file this UHT form. Okay, so that's the key. So if you're on title, if you and somebody else are on title, and that's the way you're sharing the revenue, and if that's the way it's registered in the land registry office, you're good. You don't have to file. But if you've got a joint venture, there's a lot of real estate investors here through Wealth Genius, the group I belong to. There's over 1,000 people registered. All of them have written joint ventures. Okay, if you have a joint venture, so I have joint ventures. So if you know, for example, apartment building, the way I buy an apartment building is go find a deal. And the bank, if it's a $2 million apartment building, the bank will give me 2/3 of that money, assuming the appraisal is good and the inspection report is good. So if they're going to give me 1.3 on 2 million, I need 700,000. And another 100 to close the deal, have some working capital. I need 800,000. I just go to my database. Who wants to invest in an apartment building? Let's say 8 people provide $100,000. Those people are joint venture partners. Okay, now we got to file these forms if you have joint venture partners. Now, the bigger multi-units are exempt. It's basically 4 units and under that you have to file these forms for. If you got an 8-plex, don't worry about it. You got a 12-plex, don't worry about it. 4 units and under. And if you have joint venture partners, you have to file. Okay, because in most cases, your name is on title and you're bringing in people. So be careful about that. At first there was mega penalties, $10,000 if you're a corporation, if you didn't file, nuts. $5,000 penalty if you're a person and didn't file, once again, nuts. Then they lowered that to 2,000 for a corporation and 1,000 for a corporation. 1,000 for a person. So there are penalties for non-filing. Who knows if they're going to once again cancel the filing deadline of April 30th. We're all geared up. I'm doing UHT filings all this weekend. So anyway, so just be aware that that's out there. So anyway, that's it. Somebody asked me about the Dominican updates. Yeah, so went down for a little 3-day working trip down there last week. Oh my God. I don't know if you Google Sosua flooding. Oh my God. So here I am for 3 days there. And on the Tuesday, it was the worst flooding in the history of the Dominican Republic. It was insane. Okay. Literally, I'm looking out my window, watching the water come up over the road. Watching, if you've ever been to Dominican or these islands, you know, these little motor scooters flying everywhere. They come and hit the water and fall over. And, you know, the ones that make it through the water, they're all high-fiving each other. It was amazing. But anyway, interesting experience, but we're still very active. Right now, we don't have anything to offer in the Dominican, but we are very active. We are looking for different opportunities down there. I'm sold on the area. We're on the north side of the island, the Puerto Plata, Sosua, Cabarete side, which is a little more rugged. It's not the real 5-star experience. If you're more of a 5-star experience person, you got to go down south on the island to Punta Cana. The north side's a little more of a Cabarete. That's the windsurf capital, kiteboarding capital of the world. So there's some pretty cool stuff happening. But for example, in Sosua, there's only one 5-star all-inclusive venue. And actually interesting, I'm glad I'm talking about this because part of the inner circle we're creating, once a week, we're going to go down there every year. We're going to invite anybody that's involved in our inner circle to come join us. It's going to be a week of education and fun in the sun. So anyway, that's that. That's enough for that. Any other questions before we call it a night? Sorry to keep you so long. I usually try to keep you an hour, but we're at 9 o'clock almost. So seeing none, I thank you very much for joining us. Appreciate your time as always, and we will see you next. We have these things the last Thursday of every month, and we will see you at the end of May. Thanks for joining. Take care. Bye.